Hi traders, in this very video I'm going to be giving you guys a complete liquidity trading course. Right, in this very video I'm going to break liquidity down in a way every single one of you are going to understand it. Institutional traders are the ones who are going to enter the market that is going to push the price up or make the price go down. Right now, for them to enter into the market, they need one thing: liquidity. Right, they need liquidity to enter into the market, and if they take a sell, they need liquidity to take that sell. If they're taking a buy, they still need liquidity. Now, there are two things that the market always do. First, if the market is going up, you're interested in buying that very market. And if it's going down, you're interested in selling that very market. Now, you won't take a sell and the price will actually go down. You take a sell, and these traders need to actually step in, take a sell that's actually going to make the price go down. If you take a sell, the price will not go down until those traders are able to enter the market. And what's always going to help them enter the market now is the liquidity. So in this very video, I'm going to break liquidity down in a way you guys are going to understand it, tell you what it is, what to do, areas of liquidity, and how to avoid being the liquidity to the market. So without further ado, I'm not going to waste time. Let's jump right to the video. So first things first, what exactly is liquidity? Liquidity generally is money present within the market. Now, there are two things, right? There are two things. Market needs liquidity to fill orders. Now, if any price is going to move, the market works on supply and demand. Once the price gets to its supply level, it's meant to sell, right? Like, if the price gets here now, goes down, that's a supply level. And those who trade support and resistance, that's a resistance level for them, right? Then those who trade order block, they have their order block right there. So different traders want to sell from there. And what are they expecting? They expect the price to come back there and they sell. Generally, that's what every single trader is expecting. And that's how the market moves on a normal case. If the market is in a downtrend, it's going to come back to that supply level, go down, create another supply level, get to that supply level, go down, create another supply level, then come back to that supply level, go down, just to keep filling orders for international traders to keep selling at those different supply levels. Now, for the price to sell from this very level, for the price to sell from this very supply level, now it's going to need liquidity. And there are two ways the market is going to get this liquidity to sell, right? For the price to actually sell, for international traders to actually enter for their sale at that very supply level, there are two ways the market is going to get liquidity. Now, the very first way which international traders are able to enter for their sale is when there's already liquidity present in the market. When the liquidity is already present, right, in the market. Right, in this case now, liquidity is already present within the market. Now, in this case, if they're trying to sell from this very supply level, they want to sell at this very supply level. Now, once they take a sell, meaning they're going to need traders who are going to buy from them. Since they're trying to sell, they're going to need traders who are going to buy, and the order is going to get filled. Now, generally, this is what trading is. Trading is this is what traders are the ones who move the market, and once they enter the market, that's when the price is going to move. If they don't enter the market, the price will not go in either direction. Now, for them to enter into this very market, now they're going to need people who are going to trade against them, right? Maybe you're trying to buy, you're going to need people who are going to be selling that same currency. And if they're trying to sell, they're going to need traders who are going to be buying that very currency. So at this very supply level, and they need traders who are going to be selling. So if they're trying to buy, then they're going to need someone who is selling. Now the trade will be executed, buy from this very trader, sell to this very trader, and it's going to be smooth. And this very seller now, who is in this very market, who is making this order filled, right, who is getting this order filled now, is the liquidity already present in the market. And that's the first way these institutional traders are able to enter for their trade. I'm going to show you a live practical example how it is on the chart, right? So that's the first way they're able to execute their trade. If you see the price going up, it means, and if you start buying from a demand level without taking out that demand level, it means there's already liquidity present at that very demand level, or in that very demand level. That's why the price was able to buy. Now, the second way, which is this very one that every single one of you guys need to know, and this is the one that do affect we traders most of the time, right? This is the one that will do affect we traders, that do make us hit stop loss, make us lose money, right? It's gonna be the liquidity, right? The liquidity from our stop loss, Now, in case you don't know, right, we are not the only ones who are gonna lose money. Retail traders, we don't even amount for the amount those international traders enter the market with. So some other international traders who are not informed about the market, who don't really understand this, who don't trade with this, right? Who don't consider liquidity in trading, right? Who don't consider the price sweeping liquidity in trading, they're gonna still fall for this. So it's gonna be stop loss from both we retail traders who are taking trade without getting the liquidity and getting stopped out. We're gonna be the liquidity providing. We're gonna be the ones providing this liquidity for the market. Now, generally, other institutional traders are also gonna lose money. They're also gonna be the ones providing liquidity for this same market. So it's not just liquidity from we retail traders stop loss. I know that's how you know it. It's not always just from our stop loss alone. Now, generally now, it's going to need liquidity from our stop loss, meaning it's going to need to stop us out for it to buy. Now, if the institutional trader is trying to sell from here, they're trying to take a sell, they're going to need someone who's going to buy from them, right? Who's going to buy, and that means there will be liquidity present in the market. So the sale will be activated and the market is going to go down. But if there's no liquidity present at that very point, what's going to happen? They're going to need to stop us out. They're going to need to stop us out. We're going to need to hit stop loss so they can easily enter the market. And if you watch this, I just told you, this is a resistance level where traders will likely sell from. This is a supply level where traders will likely sell from. This is an order block where traders will likely sell from. And if every single trader who trade any of those things I just mentioned is trying to sell from here, their stop loss is going to be above that very high. I'm going to give you areas of liquidity and how it is. Now, above that very high, and what the price does, once the price goes up above that very high, you're going to get stopped out. Other institutional traders who try selling from that supply level are going to get stopped out. And what's going to happen? Once they get stopped out, liquidity has been gotten in the market. Now, the institutional trader who tried selling is going to be able to execute his sell, and the price will now start going down after hitting your stop loss. That's exactly what the market keeps doing every single time. So these are the two ways the market is able to get these orders filled. Either there's already liquidity present, meaning it does not need to go up to take out that very high first before going down, or to take out the liquidity above that high first before going down, or it's going to take it out before it goes. I'm going to show you how we trade it, how we go about it right now. Liquidity is the money present in the market, and market needs liquidity to fill orders. And I believe you now understand that. And the market moves on supply and demand. Now, practically, this is a nice example. What did the price just did? This is a nice example right here. What did the price did? This was a high, which is a supply level, a level where international traders want to sell from. What happened? The price got there. It took out that high first. You can see it took out the high. Every trader who tries selling from here, you can see they get stopped out. This was not. I'm just putting this to show you practical examples. Every trader who tried taking the trade from here now got stopped out. And what happened? The price is now currently going down. International traders were now able to execute their sell, and the price started going down. Take a look at this other one. In this very case, this is another nice demand level where the price got to, started pushing up. A nice demand level. What happened? The price came back here. On getting here, started buying without taking out that very point, without first going below that very low. Why? Because there was already liquidity present. So many traders has been stopped out from this very low. I'm going to show you how we trade it, right? Or how I trade it, literally how I trade it. So many traders have been stopped out from this very low. That's why the price is not need to take out this second low before it will move. Liquidity is already present in the market, right? The trader was able to execute the trade. And simple. The price started buying, started selling. Right? Similar one right here. A high, price had to take out that high first before dropping. A low, price to take out that low first before buying. Keep doing it over and over again. A low, price had to take out that low first before buying. Right? I'm going to show you some practical live example right on the chart. So that's generally what liquidity is. And these are areas of liquidity, right? Where you can easily just see and then know, okay, there's liquidity here, and there's a chance that the price is going to sweep this liquidity. It's going to take out this very liquidity. So above every high, there's liquidity, and below every low, there's liquidity. And knowing this, you know the price works on supply and demand. Once the price gets there, goes down. Traders who trade order block, they're going to mark at that level as an order block. Traders who trade supply and demand, they're going to mark at that level as a resistance or a supply. Once the price gets to a point and goes up, is a demand for them. An order block, a support level for traders, right? And they want the price to come back here and they buy. And if they are buying, where's their stop loss? Below this low. If they are selling from here, where's their stop loss? Above this very high. Now, what always happens? The price is going to come to that very point, take out that high, meaning it's going to hit their stop loss. They will lose money to the market. They provided liquidity for the market. And what's going to happen? It's not traders are now able to execute their sell and the price started dropping. Similar thing, take out that very low. International traders are able to execute their buy, price started buying. Now, if they're able to execute it without taking out that low, get to that very point and start buying, meaning there's already liquidity present in the market. That's why they're able to execute it when the price was there, right? So now that's the first area of liquidity. Above every high, every single high you see, there's liquidity. No matter where the low is, no matter where the high is. This is a low where the price got to started buying. There was liquidity below that very low. Take a look at what the price did. On coming back there, it took out that low first. Right? What did the price just did? Took out the liquidity below that very low. Every trader who try buying from maybe this order block or this support level or this demand level are gonna get stopped at first. They're taking their buy from maybe this order block. I believe many of you watching me, you guys trade order block. Now they're taking their buy from here, stop loss below the order block. You get stopped at, and you will actually write with your analysis. You get stopped at, price started going your way, just to get liquidity to follow the move, right? So international traders can execute their trade, and I believe you now know that. Now, another one. This was a high. The price had to take out the high first before selling, right? This was a low. Price went up, came back to that low, did not take out the low before buying. Why? Because it took out multiple lows already before getting to that very low. So that's how I'm going to show you how we trade the liquidity. So that's what we do. The price needs to take out that low already before getting to our point of interest, which is where we take the trade from. So generally, the second area of liquidity is the trendline liquidity. In this case now, trendline liquidity has the most liquidity, right? And in this case, this is how the price always do it, right? And this is what the price always does. So you should write it down. Trendline liquidity has the most liquidity, and in this case, the market is bullish, creating higher highs and higher lows. And what is this showing? Showing you that this market is an uptrend. Where we have this bullish market, it's an uptrend. And this trendline has liquidity. Why? Because those trendline traders, they want the price to come back here and they buy. And once they are expecting that, what do you think they're going to do? They're going to take a buy from the trend line. Taking their buy from the trend line, stop loss below the trend line. Right? And if they're taking trade like this now, the price comes to the trend line, trigger their trade and move, they make money. But if the price goes below that very trend line, break that very trend line, they're going to get stopped out. So the first liquidity has been gotten. Traders have been stopped out, and these are the first liquidity present in the market. Right? Traders have been stopped out on this very first move. Now, you're going to see this is a low in the market. This is a low point, which you know, above every high and below every low, there's liquidity. So this is a low, and this low has liquidity. Another low, this low has liquidity. Another low, this low has liquidity. Another low, this low has liquidity. Now, all of these now, they are accumulated within this trend line. So this is called the trend line liquidity. First, those who try buying from the trend line get stopped out. If the price still go down a little, those who try buying from the second support level or the second demand level get stopped out. If it goes down again, those who buy from this second one get stopped out, right? And now, why do you need to know this? Why do you need to know about this trendline liquidity, to know about trendline liquidity, so you won't be a trap, so you won't be among the liquidity that is going to be taken out? Now, this is why you need to know. If you mark at this first zone, you take your buy, you get stopped out. Maybe you trade order block or support and resistance or supply and demand. This is a demand. You say this. Let me take it from this second one. Since this one did not hold, you hit stop loss the second time. Then you say, let me take it from this third one. You hit stop loss the third time. Now, if you have the knowledge about this trendline liquidity, you're gonna know you should not be taking the buy the third time. You should not even take it the fourth time. Why? Because that's a trendline liquidity. The price is sweeping, and until the price is done taking another trendline liquidity, that's when the price is gonna buy, if it's gonna eventually buy. And that's what keeps happening over and over again. I'm gonna show you some practical examples on the chart. Right now, what we do, how we trade it is this. So this is exactly how we now go about in trading this. So you should write this down, how I trade it. So it's gonna be how I trade it. So you'll know if that's how you'll be trading it as well. Now, in trading is the first thing I do, right? I mark out key levels, or I mark out key order block or breaker block, mark out OB or BB below or above the liquidity. Above the liquidity. And you know, the liquidity now is going to be above or below a low or a high. Right, generally, which is now what we call inducements in the market. Let me show you a practical nice example. This was a buy I took, right? I had it set up, I guess, on my phone. So this was a buy I took right here. And take a look at exactly how I took this very buy. What did the price just did? The price had this low, which is the point the price got to and went up. This is a low, which has liquidity. And what the price did? Came back, took out that liquidity. On taking out that liquidity now, I mark out my point of interest, which is my order block or breaker block, below the liquidity. And immediately the price took out that liquidity, what happened? It tapped on my point of interest and started buying. Why? Because liquidity has been gotten, immediately it took out this very low. Immediately, traders who are going to buy from here now, they get stopped out. Money has been gotten into the market. Liquidity has been gotten. What happened? It started buying from here. Another nice example right here. I have this order block. I believe you guys know what order block is. Then I have done video about it. If you don't know what it is, just go to the video I've done. Then I guess in some other of my video, I'm going to talk about the strategy again, which is the strategy I use. Now, in this case, I have this order block, this last black candle. What happened? The price had this low, which is going to likely be a liquidity, which is a point I already take my trade from. If I don't take my profit early, I target 1:3, thereabout. If I don't take my profit early now, you can see the price came back down to take out all the liquidity below this low, below this very low. And finally tap on this POI, which is the order block, right? Point of entry where I'll be taking my buy from. You know, this is a demand level. Demand level now where I'll be taking my buy from, or a support level where I'll be taking my buy from. Tapping on it, started buying up. Why? Because there's liquidity present in the market already, and the price was able to buy from this very zone, right? So let's look out for more opportunity, more examples. Many of you trade gold. Let's see what gold is doing. Now, take a look at what gold did. This was a high in the market. What happened? It took out that high first before dropping. Another high. It even took out the second high first before dropping. Right? There was multiple opportunity I caught on gold. Another high. It took out that high first before dropping. Now, you're going to ask, if it's going to be taking out all of these highs, where should I be taking my trade from? Which what I just told you. I want to mark out my key level, my point of interest, point of entry, which is, I don't know what you use as your entry, maybe an order block or a breaker block or support or a resistance or a supply or a demand. So depending on the one you use, depending on how you mark it out, if you mark at that level, you want to check, is there liquidity protecting that very level? If there's liquidity protecting that very level, then that's a valid level and that's a good level you can easily take your trade from, either a buy or a sell. So let's look out for more opportunity and more examples. A high, what happened? The price took out a high before selling. Now let's look out for the trendline liquidity, where the price has the trendline liquidity. At this very point, let's mark it out. Let's mark it out correctly and perfectly. And even recently, gold has its trendline liquidity, which gold is currently sweeping. So now at this very point, take a look at this right here. At this very point now, gold has its trendline liquidity. A point, the price went up, came back there, went up, came back there, went up. Every trader wants the price to come back here and go up. Those people trade trend line. But what happened? Price took out that trend line. This was the first low. Price did not buy from there, it took out that first low. Another low, price took out that second low. Another low, price took out the third low. Why? Because that's a trend line liquidity and the price needs to take out that trend line liquidity. Right? Multiple times, this is what the price keeps doing. So if you have knowledge about this, you will know that, okay, I won't be buying from all of these different lows because there's a trendline liquidity accumulated right there, and there's a chance that the price is going to take out that trendline liquidity before moving. And this other move right here was also a trendline liquidity sweep. So take a look at this right here. The price having these multiple highs. Now what happened? a high, price went down, another high, just a trend line. What happened? When price started buying, it took out this first one, took out the second one, took out the third one, till this very last one where the trend line ended. That was where the price stopped and started selling. Why? Because that was a trend line liquidity, and the price need to take out all of this trend line liquidity. So if you're going to be trading, you want to watch out for, okay, is there a trend line liquidity? Am I among the trend line liquidity? And secondly, if the price is going to start buying from this very level, where is the liquidity in the market? And like I told you, as far as is a demand level or as far as is a supply level, traders are waiting to sell there and traders are waiting to buy there. Any market at all. There was this trade some of my students caught. Right, some of my students caught it. And by the way, I'm so sorry for not doing video for some time now. Right, for like 2 weeks I've not done any video, and I've been active on my Telegram where I drop signals. The Telegram link is in the description. Then I've not been active doing videos, so I'm so sorry about that. I've been traveling, but I'm back now. So let's make some money. Let keep learning from what I'm doing here. Now, this was a low. This very low now is not a point you will be buying from. Why? Because this is a liquidity. There's liquidity accumulated below this low. So why is it not valid? Why is it a liquidity? Because there's no other low, no other clear low protecting that very low. So this is a liquidity now protecting this very demand level, or this very, we mark out, I trade with order block. So protecting this very order block. So now what the price did, took out that liquidity, tap on it, and started buying. And I'm multiple about over a couple of my students called this very move. Right, so many of my students caught this very move. They caught the euro, this very move, and I also caught it as well. So let's look out for other areas where the price did similar thing. What the price did right here, low. Took out that low before buying. Let's look out for another nice one so you understand it better. Another low. Took out that low first before shooting up. So this is what the price keeps doing. You can see this very one, it is also obvious that it was a sweep, right? It was just a clear sweep and a clear liquidity grab. Right now you can see how it took out this very low. Immediately took out that low. What happened? Started shooting up. Immediately took out that very low. What did the price did? Just took a little liquidity and started buying. Now another area, which is this order block right here, that's what I trade. Then what happened? High liquidity. Took out that liquidity, started selling. So literally this is how it's always happening. Right? If you want to trade with the strategy I trade, just go over, check out my other videos on YouTube. Then if you want to join my mentorship class where I teach my students, I don't know when this video is going to be out. The July mentorship class is currently on. So just click on the link in the description to join. Then literally in my next video, I guess I'm going to do a video on on structure liquidity POI, right? Showing you live how I do it and how I take trade. And also I'm going to be doing live trading with you guys. Right, I'm now much available now, so I'm going to be doing more live trading with you guys. So take a look at this price. That is, I went down, took out a high before dropping. So this is what the price keeps doing over and over again. Now you now understand why the price moves. If the price is going in any direction, why it moves. It needs liquidity. That's what fuels the move, and how the price always do it. Is either there's already liquidity present in that very market, or the price is going to take out the liquidity before moving, right? Just like that, and that's what the price keeps doing. So if this video was helpful, like the video, and like I said, just join the Telegram. I'll be dropping link on the live trading. From time to time, I'll be doing live trading with you guys. So, and I'll see you guys in the next video. So take care, guys.